Hi, I'm Paul. Where's Seth? You know what this is like? This is like in Wayne's World when Wayne leaves and Garth's up by himself and he's like sitting there trying to do the show and it's like really awkward. So my Wayne is gone. All right, so we're gonna do JD.com today. JD.com is China's second largest online retailer, second to Alibaba, right? It's been around since 2010. Went public in around 2014. Nice. It's up a lot since it went public. What was that, Mo?
It's up. Yeah, it's up a lot, and it's up a lot since pandemic time.
Well, right, but look at look since February.
Oh yeah,
hit a high of one. So here's the deal, folks. Well, I want everybody to remember this. February 17th, it hit a high of 107, right? If I told you on February 17th it was going to drop 30% in the next couple of months after you saw this, what would you have said to me?
You're crazy.
Yeah.
Especially in the market environment that we're in.
Right. And it went down 30%. Yeah. So we're going to look at JD, but I always want to reiterate that stock prices can do very random things very quickly. Joel Greenblatt in his book, The Little Book That Beats the Market, always says, look at a stock, look at its 52-week high, 52-week low, you'll see big differences. So your job is to find a stock at the price you want and just be patient and wait for it. Either valuations will go up and the stock will stay stagnant or something will happen. All stocks at some point sell for value. Yep. You just have to be patient about it. So let's look at JD. $113 million market cap, big time revenue, $124 billion, profit of $8 billion, which gives you a PE of 14. That's a check mark. Low profit margin, 6.5%. That's an X. No dividend.
That is very low.
But a high return on assets, 13.3. So this might be a Joel Greenblatt stock at some point, but high return on assets, 13.3%. So one check, one X so far. So let's go look at the income statement for our annual revenue growth. Look at this, tripled. 43 billion to 124 billion. Check mark there.
Was 2020 an anomaly? I can't see it from here.
No, 75, 93, 124. Okay. It might be an anomaly, but we'll see.
No, I was just seeing if it had a big jump because of COVID or something.
So remember, this is China. China has the fastest growing middle class, I believe, in the world. So you would think that there's a lot of growth potential in this company going forward. So keep that in mind when we do our stock analyzer tool. Net income. Well, look at this, guys. Negative 327 to 8 billion. Oh my lordy. Did you see this profit jump in the last year?
What was it?
$1 billion to 8 billion. Woo. Yeah.
There you go. There you go.
Oh, other income and expenses, $6 billion. Okay, guys. So here's the deal.
Here, yeah.
This is why we look at financial statements. They had an extra income, other income and expenses. You need to go find out what that is. Mo, do you mind doing a quick research to see what that is? So this is a one-time income charge. This isn't from operations. So the PE of 14 is very misleading right now. It's actually looking like it was actually $2 billion in profit, which makes it a PE of 56. 56 on a $112 billion market cap divided by 2 is a 56 PE versus the 14 reported. So this is, I was actually looking at it going, how is it only 14 PE? This is a fast-growing company. This is some of the stuff you have to watch for when you look at companies. It's selling for actually 56 times normal income. Because look at the previous years. They had other income and expenses every year, but it went from a loss of 260 million to a gain of 6.2 billion. These are huge fluctuations, and the average investor who doesn't pay attention will just look at the PE and say, oh, look at that PE, it's very low, I should buy this company, not looking at the financials, which you're doing to understand that, wait, they had a one-time other income and expense of $6 billion. We gotta pull that out of there. Just like if there was a one-time loss of $6 billion, we wouldn't include that in there. We'd take it out saying, wait a second, it's one time, it didn't happen, so you need to figure that out. Shares outstanding, 1.42 to 1.55, that's an X. So they are increasing their shares slightly. Any word yet, Mo?
No, I'm gonna pull up their annual report.
Okay. All right, so far, guys, we have few checks, few X's. I think only 2 X's so far. One is profit margin and one is shares outstanding. Now remember, the PE is skewed, but we're still gonna stay consistent with our trailing 12 months PE. Now this software here, guys, I wanna make note. This software is incredible. This is built only for Everything Money. You can only have it here if you join our Patreon below. It gives you access to all of our software, all our stock analyzer tool, everything you have here that's coming. It's an incredible piece of software. You have to ask yourself, is it worth it for me to learn? There are 3,600 people who have the software right now. There's a Discord community, very organized and structured. You can talk to 3,600 people about all your investment ideas, be around like-minded people, because as Warren Buffett says, show me the people you're closest to and I'll show you how you end up being as a person. 80 cents a day, your price is locked in. It's going to $1.50 a day. It's gonna go to $50 a month here at some point. So get in now, 80 cents a day. You're crazy not to sign up for it. All right. Pillar number 6, balance sheet. Current assets, $35 billion. Current liabilities, $25 billion. Total liabilities, $32 billion. So guys, they have plenty of cash on hand to pay off all of their debt, not just their current liabilities. This is a wonderful thing. It's very hard for companies to go bankrupt when this is the case. Here's my broken record comment. It's like you having enough money in your personal checking account to pay off your entire mortgage, all your student loans, all your credit cards, all your car payments, every debt you have paid off with a stroke of a pen, just from the money sitting in your personal checking account. All right. So now for the big mamma jamma, the cash flow. The cash flow statement. Oh boy. Let's go to our annual numbers. Here we go. All right. So we're going to go to our annual numbers for all of last year. So we had $619 million to $4.65 billion. That's a check with an average of 2.2. 2.2 times 20. Why do we pick 20? It's a starting point, folks. As cash flow is increasing, you want to pay probably around 15 times free cash flow or less, depending on the growth prospects of the company. And as the company's growth prospects are more, like this one, you want to be paying a higher multiple. We just started at 20 as a starting point. 44 billion. That's an X because the company is currently selling for 112 billion. So it's a little overvalued from that metric. But what we're going to do now is we're going to go put it in the stock analyzer tool that will factor in the growth potential for the company to see what you should actually pay for the stock. Because remember, a fast growing company, you should pay more for it. How much more? That's the question. That's what we're trying to teach in value investing. Mo, any word yet?
No, I'm not finding it.
All right, why don't you do the, can you do the trading chart, and I will look more myself.
Sure. So looking at JD, I mean, if you look and just draw this line across, and this is dating back to August of this year. So you are at some kind of support level right now. And today is the day where we're having this little chaos in the market. So let's zoom in and see the little gaps that we have moving down. Right now, you're in the sweet spot, but you're kind of looking like you're going to do some kind of sweet spot reversal. And this could be because of the volatility that we've seen this week. Now, these gaps, they will fill going up. So if I was you, I would just be patient with this thing, let this stochastic settle down. It's going to go sideways for quite some time, and then let it choose a direction that it's going to go in. This is one of those times where I'm telling you, go find other options out there where your stochastic is kind of giving you the direction, that giving you some kind of indication. Let's pull up the long-term, or the daily chart just to see some more detail. So this worries me. You are under all 4 of your major moving averages right now, and that's where the stock went today. So going to the upside, you're going to have a lot of resistance to get through. You're going to need a lot of volume to get through that point. So maybe if you do get a downtrend, this is an opportunity to short. But remember, you're going back to resistance. It's back to August. If you find it?
Yep, I found it in 2 seconds. Once I Googled
what is it?
JD other income.
Oh, I Googled that too. I didn't find it.
Really?
Yeah,
if you Google that, it would have told you right there in the first line.
What does it say?
Change in the market value of their equity investments.
Oh.
So nowadays, companies, and this is something Warren Buffett and Charlie Munger have talked about that they don't agree with. Now, as the value of their investments go up and down, they have to be included as other income and other losses, even if not realized. So JD is reporting an increase of $6 billion in their other equity investments. You need to strip that out. It's because it's not even even part of their focus on their operations, right? That's why we look at their cash flow, because it's cash from operations less their capital expenditures. So let's put it into our trusty stock analyzer tool. We're going to do a 7-year analysis. Now, guys, remember, we don't have a 10-year analysis here, but we're going to look at this stock analyzer tool allows you to look at the 1 and 5 year annualized return, annualized rate changes, and then decide from there what you're going to do. So let's see here. Low, let's call it 20% growth, 25 and 30% the high side. Share change. Now, share change and desired annual return, you want to start at a higher number for low and a lower number for high. And here's why. You have to figure out on the low one, which one makes the stock price go down. In this one, issuing more shares over the long run will make the stock price go lower. So you want to assume that as your conservative estimate. Okay, so let's say 5, 4, 5, 3, and 1. Profit margin 3, 4, and 5. Free cash flow 3, 4, and 5. PE of 15, 18, 21. It is a faster growing company. But still, at that point, it won't be as fast growing anymore. And then same thing here. I want 15, 12.5, and 10% return. So guys, I hit the analyze button. It's at $73 a share right now. The goal of the stock analyzer tool is twofold. Either you've done so much research on it and now you know, hey, here are my real estimates of growth and all these share changes. I know what I'm doing here. Or two, do what I just did here. It's part of your initial research to say, when it gives me my values, I can determine, is this thing really overpriced, somewhere in the middle, or is it low? These before I do more research. Because if it's massively overpriced, let's say, for example, the highest number comes in at $30 a share and it's selling for 73. If I'm you, I just stop looking. Don't even do any more research. It's not even close to the level. If it's at 70, okay, maybe you start looking further. So let's scroll down below. Oh, wow, look at this.
What do you got?
This actually looks like a pretty good deal.
Oh.
Low side, it has $51, high side, $308.
$70 right now.
So it's $70 right now, guys. So if you believe that these conservative numbers are accurate, you're not far off from, you're probably going to be making 13, 14% buying at today's date, probably today's numbers. That's not bad. So something to consider when looking at this, the middle numbers right here, if you believe that's going to happen. Now, 25% revenue growth over the next 7 years, that'll take you to how much revenue? $500 billion, okay? So you have to ask yourself, do I think JD.com is going to do $500 billion? Well, again, China's middle class is the fastest growing middle class in the world. It's got a huge population. Maybe that's the case. I think Alibaba was a better deal, if I remember correctly. I think it was a better value play. I think it was better valued stock, than JD, but JD's smaller, has more upside potential. This might not be a bad play.
Still a Chinese company, though, so.
And then my caveat for all Chinese companies, and it's not meant to be a jerk or any sort of comment. It's just there's been history of numbers coming out of China, Chinese companies being inaccurate. There's been a lot of fraud involved. Proceed with caution, but I'm assuming that all the numbers are accurate here. I'm not assuming that. I'm just going to assume that today that all the numbers are accurate. Mm-hmm. So right now, our final take on JD is it actually might be a decent deal right now. You might be able to make definitely double-digit returns as long as you're willing to be patient.
Yep, could be. And if you want to go at it from a charting perspective, this might be a possible short coming in the near term. So very different from value. So guys, the recap is watch the stock. I think there's a lot of potential here. Also, join the Patreon, where if you have questions on this, you can join the Patreon, join the Discord, have conversations with other investors, get access to these tools that will make you a better investor. Video right here explains it all. This is literally a no-brainer. Go do it. Thanks very much for watching.